All right, welcome to the Safe Wheel live stream where I share my real P&L on 3 accounts and teach my proprietary Safe Wheel options trade system for free. The system, the Safe Wheel, is currently up 21% year to date. Please type in the chat that you can hear me. I'm going to assume that you can. I'm going to the chat box. Sound is good. Thank you. Okay, good. All right. I want you guys go ahead and post any questions that you might have. Today's going to be a little bit different because we're in a situation where I think that we've never been before with the safe wheel. So that's going to be a little interesting. And there might be questions. Try to post your questions as early as possible because sometimes they try to come in towards the end of the broadcast and I kind of miss the questions. All right. First, I'm going to talk about the other two systems that I'm running. First, I'm going to go over the earnings edge. Okay, so this is the account for the earnings edge. And you can see my P&L year to date and all of the underlyings that I've traded. Now, last week, there's not a lot of earnings going on, and there were no underlyings that met all 8 filters. Therefore, there was no trade. So my overall record with the earnings edge is 20 wins, 6 losses, and 3 ties. And while using the 8 filters, my record is 5-1. And you can see I started with a $5,000 account and I'm down about 5% year to date with the earnings edge. So the earnings edge is available. There's a link in the description if you're interested in getting involved on the alert with the alert system. Okay, let's go to the Premier Level 5. So the Premier Level 5 is where this is the conservative approach. We keep our drawdowns to a minimum. Currently, I have 7 wins, 2 losses, 2 ties, and 2 open trades with this system. And you can see the P&L. We started with $30,000 and we're at 31,775. So we're up approximately somewhere between 5 and 6%. Now this particular account has been down maximum about 4%. So we're doing quite well. Now this opened on April 18th of this year. The S&P 500 has been down 19% since that time frame, and the S&P 500 is down about 8%. Now this is since April 8th. So in comparison, we're up about 5%, maybe 6, and the S&P 500 is down 8. So that's outperformance by around 14% over the S&P 500. Plus, you had that 19% drawdown. We only came down 4%. So it's a lot more conservative in terms of the drawdowns, and then it will outperform. Typically, sometimes in the bull market, it doesn't outperform, but the fact that it did not draw down as much in the other types of markets, in the grind down or the crash or the sideways market, the fact that it does not draw down as much, so it has a better starting point, so it outperforms the S&P. Okay, so let's get to the safe wheel. That's this account here, yeah. We're trading FCX, and what happened last week was FCX went down so far, it started getting close to our hedge, and got deeper towards the hedge, and I actually put on a second tier. So I did a tier 2, which I think I've done maybe once before. So I sold another put, so I opened up a second position. And the reason why I could do that was because the stock went down towards my hedge. So my hedge was getting stronger and stronger and stronger. And I was able to put on a second tier and put on more risk. Because my hedge was getting stronger, I had the ability to put on another position. Now, what happened to that position? Well, I sold that put and it expired worthless. And you can see FCX is trading around 32.63. So FCX was, I think it was around 28. You know, it's getting close to this $26 level. Okay, so what do? I'm looking at my flow chart here. Now, this flow chart is available. There's a link in the description. So it basically says, after I add my second tier, is the stock up or sideways? So the stock is up since I added my second tier. Um, and the question is, can I sell a covered call above my assigned price? Well, what was my assigned price? Well, I own 100 shares. My assigned price was $31, and it's selling at 32.68. So I know I can sell a covered call. Okay. So the answer to that is yes. I can sell a covered call out of the money and above 1%. Over $30. So the answer is yes. So the next question is the position profitable? So is the overall position profitable? So we're looking at FCX year to date, $136. Yes, I know that the overall position is profitable. Okay, so the answer to that is yes. So keep the put hedge. So if the position is profitable, then it says sell the whole position and start over. Okay. So since I'm put on a tier 2 and I'm holding these 100 shares and I made a profit, or I haven't made it yet, but I can sell this out for a profit and the overall position is profitable, I should get out and start over, which is what I'm going to do. But I'm not really going to I'm not going to start over only because I'm going to keep this put hedge and keep this FCX. It's as if I'm starting over. So let's do some numbers. Let's say that I'm starting over and I want to use FCX. So I'm trading at what? 32.57, 32.57. Let's say times 0.8 to see where my hedge would be. It would be at the $26 put. And my hedge is over 150 days. So if I wanted to start all over, I could use FCX and I would buy this same put. Okay, so I'm just going to sell these shares out, take the profits, and just start the whole system over, start the whole cycle over. I could start the whole cycle over with a different underlying if I wanted to, but I'm just going to keep FCX because I already have the put. Why go through trying to sell that put and then buy another one in some other underlying when I already own it? So what am I going to do here? I'm going to sell this out. I'm going to close it out. 32.61 is the mid. Try to get as much as possible. Okay, sold. Okay. So now I'm just sitting here with a hedge and I want to start over. Like I said, I could just sell this hedge out and start over somewhere else, but why should I do that? I've already got a good position. So now what do I want to do? I want to start over. I'm going to sell a put. I'm at the 32.50 level. I want to sell something out of the money. I could sell the 32.50, but that wouldn't be really far enough out of the money. But I can sell the $32 put, and I'm in this particular expiration cycle, the closest one. So I'm going to go a little bit out of the money, $32. Sell this. I'm going to do one because that's my sizing. I'm between $5,000 and $10,000. Try to get as much as I can for it, as much credit as possible. Okay, filled at 62. So collected $62. Now I want to protect my put hedge. So I'm going to stay in this closest expiration cycle. I want to buy something for around $5 or $6. So that's $7 too much. This one I can get for probably $5 or maybe $4. Buying that $38 call. Okay, I'll go up to $5. I'll even go up to $6 if I need to. All right. So now, oops, we have our position on. We've got a put hedge. We sold a put. We bought the call to protect this put hedge, and we'll just collect the premium. So we collected what, around $60 in premium, paid around $5 in protection, and that $60 should depreciate faster than this put hedge. So we're getting more depreciation than we are. Uh, we're capturing more depreciation compared to what we're paying for with our hedges. Okay. Now the safe wheel guidelines flowchart and also the guidelines on how to pick the correct stock, I have that available there's a link in the description if you're interested. And I keep thinking that I'm going to raise the price on it. I've got it at a really low price, and I may raise the price in the future, but right now I'm going to keep it low. Okay, so let's take a look if there's any comments or any questions. We've got the sound is good. Sound good. Good morning, Kevin. Okay, right here. Why don't you sell covered calls against 100 shares of SCX? I could sell covered calls against it, and that is really not a bad idea. And that really could happen. And I was thinking about that this morning. You could do that. You sell those covered calls, your profit. The thing is, if you sell if you still hold the stock while it's profitable, you're at risk if the price comes down. You're at risk of losing that money. So I just, I said, all right, I've got those 100 shares. I've got the profit. Take the profit. Even if I sell the covered calls, of course, I'm going to make profit because the covered calls will cover me on the way down. So I could do that, but I think it's just simpler. It's easier to just start the whole system over, make it more clean. So mainly, probably the reason or the answer for that is just to make it cleaner and easier. All right. I don't see a lot of questions today. I thought I would because this is kind of a different situation where I haven't encountered it before, not that I recall, but I guess everybody kind of understands how to work the safe wheel. We're doing good, up 23 cents, 23 or 21% year to date. And Tron says, that makes sense. Yeah. I mean, it's just to make it cleaner. Okay. Well, don't forget to click the like and subscribe button. That really helps out the channel. It helps other people. It helps for me to reach other people. There might be a lot of other people that are interested in this, and we're kind of dependent on that algorithm to show this to other people. And I think a lot of people would be interested in this, people that trade options, because there's a lot of people out there that are losing money trading options. And if they did this, they wouldn't lose money, or at least not this year so far, and not according to the back test. Voodoo, for your larger account, okay, that's the Premier Level 5. Do you only do one underlying at a time with larger size, or do you manage multiple underlyings? So with my larger account, I only trade options on the E-minis, on the ES, or options on the SPX. So we only use the big boys for that particular system. We don't have multiple underlyings or anything like that. We just have one underlying, which makes it a lot easier to manage. All right, Max. Hi, Carl. The strike for my FCX long put hedge is 23, which is now less than 80% of the current strike price. Do I need to make an adjustment and roll these up before opening a new short-term contracts? Yes. You want to get it up if it's below 70%. So let's see, you're at, what are we trading at? 32.55 times 0.7. Okay, well, you're still within range. It would be $22.78 would be 70%. So typically if it goes below 70%, I would roll it up. But if I'm going to start a whole cycle over, definitely going to roll that up. So it depends on whether you're staying in the cycle. If you're staying in the cycle, you don't need to roll it yet. You're getting very close. If you're starting a whole new cycle over again, I would roll it up. Prayer kid, this seems like you need a lot of money to get started. Yeah, we started with $5,000 and we got margin. So there's a margin account with $5,000. If that's a lot of money, then I would consider, maybe continuing to make money outside of trading until you can get it up to that $5,000 level. Jerry, would you consider running the safe wheel on the QQQs or SPY or an ETF price between 20 and 40? Yes, I would. Not QQQs or SPY because they're not priced between 20 and 40. But if they were, I would consider those, yes. And then I would make sure that they met all of the 6 filters that I put together when picking an underlying. And if you want to know what those 6 filters are, I have a link in the description where you can purchase that. How to buy the correct stock for the safe wheel. But yes, I would consider ETFs or ETFs. Okay, Max, that makes sense. Thanks for your feedback. I'm glad that made sense. Okay. Any other questions? I'll give just a few seconds here to see if there's any other questions. Okay, I'm going to get ready to end the broadcast, but one thing I always like to say, if the P&L is not real, what else are they trying to conceal? Okay, we'll be back next week.